Hello, brother. Hello.
I greet you, brother.
Yeah, brother. Good evening. Yeah, welcome to today's class. Hope you can hear me.
I can hear you.
Yeah, can you see my screen too?
Yes, I'm seeing it.
Okay, good. Let's quickly start. So we'll be talking on how to project a standard deviation. How to project standard deviation. Okay, how do you know when to project a standard deviation? Yeah, let's use here as an example. We can see we took out a low here. We deliver into, let's go to higher time frame so you can see it well daily here in 4 hour. Here is our breaker in daily. So we deliver into it. To project your standard deviation, you can go over to 4 hour. That's when price is about to reverse. That's when you project your standard deviation. In a scenario when price is about to reverse, maybe to a buy side delivery or sell side delivery. So this is how you project it. We can see that we have a low here, we have a low here, then we have a high, then a lower low. Then this candle took out this high, being our breaker. This candle now stands as a breaker. Then we created a fair value gap here. So to project your standard deviation, you anchor from the low to this high before price taking it out. Before price break above it, you anchor from this low here to this high. To anchor it, this Fibonacci, that's what you use for your standard deviation. You anchor from the low to this high. You can see where I mark all this. This is standard deviation minus 1, standard deviation minus 1.5, minus 2, minus 2.5. You always target for this 2.5 standard deviation. That's where price is likely to reach out for a partial, this 2.5. Then we have standard deviation. If you are in a long trend like a buying market, you can target standard minus 3, minus 3.5. That's how it goes on like this. You will need to set your Fibonacci like this too. You can set it. I will screenshot it. I will send it on group. So you set it like this to get your standard deviation. This is standard deviation minus 1, minus 2, minus 1.5, minus 2, minus 2.5. As you have marked it like this, if you come here at your chart, you will see it now. All those minus 1, minus 1.5 standard deviation, minus 2, minus 2.5. So you always target this minus 2.5 for your take profit, initially, because we have a target of price delivering inside this weekly. This is our weekly volume imbalance. So we have target of price coming to deliver inside it. So you target standard deviation minus 2.5 for your initial profit. You can see we have trading as price deliver inside the fair value gap created after a breaker. This candle here, this bullish candle turns to our breaker. We have a low, then we have a high. This is the highest high within this range, within this range. inside this range. This is the highest high. Then we now have a low that took out to the highest high, making it a breaker. It stands now as a breaker. So after we break above this candle, we created a fair value gap, which we are seeing. This is a fair value gap BC, buy side inefficiency, sell side imbalance. We deliver inside the fair. Once we see this fair value gap created after a breaker, you wait for price to trade inside the fair value gap. You can see the body didn't trade inside it, it just dey weak. Then you can buy. You can anchor your standard deviation. Then you target 2 - 2.5 for your profit. Then you can put your stop loss below here. Once price move in profit, you can move your stop loss. If you entered here, price move in profit, then you can readjust your stop loss to your break even. If it's here you enter price, you can still re-enter here too in this fair value gap. This is another fair value gap inefficiency. This is another fair value gap inefficiency CB BC, buy side inefficiency, sell side imbalance. You can still enter here, then you target standard deviation minus 2.5 for your take profit. You can see how we deliver inside it. This shaded area is our weekly volume imbalance. So our weekly volume imbalance, you can see that here in the weekly chart. This is a volume imbalance in the marketplace. It's a void, it's empty. Okay, when you see something like this, you know that it's a volume imbalance. That's an inefficiency between this candle low and this candle high. That you will see a gap there, a space. It's called volume imbalance. Volume imbalance and inefficiency. It stands as a major resistance or support level. So you can see we didn't trade above it. It's standing as a premium level. A premium level, that's resistance. The body closed at the 50% of it, that consequent encroachment. To get the consequent encroachments of any inefficiency, you anchor, you use your Fibonacci to get the 50%. You anchor from the high to the low. So the blue line is our 50%. Okay. Hope you are following.
Yes.
Yeah, good. Here in daily, you can see how we have been trading. You can also anchor the Fibonacci or Fibonacci here. You can see this candle here. Sorry, this bullish candle. We have a low, then it's standing as a high. Then we had another low. So you can anchor from this low to the high before we took it out. Then you target standard deviation minus 2.5. If you are not confident enough, you target minus 2 or minus 1.5 for your take profit. Then you can put your stop loss below at this other block, this candle below here. Okay,
Hmm.
they are here in daily. You can go down to 4 hour. They are here in 4 hour chart. You can see here our shaded area, our volume imbalance, weekly volume imbalance. That's our target. When you see a price movement like this, price action, so you know where they have narrative of where it's going to. It's coming to deliver inside the weekly volume imbalance. So that will now allow you to enter in such area like this. You always make sure you enter in a once price trade in a fair value gap, because fair value gap is the starting point of a macro, a movement going to take out a liquidity or deliver into any inefficiency resting above or below price. Okay,
mm,
yeah. So is there any question about standard deviation? If anything you need to ask.
continue.
Okay. So you can see same cases in everywhere, something like this. It will always show every time, every day. You watch, we have a high here and we have a low here, then higher high. We took out this high, this is the high, buy side liquidity. We traded up, took out this high. Then we traded down, took out this low here. This is a displacement, displacement that shifted the market structure, that shifted the market structure. So in this kind of case, you can anchor your standard deviation, your Fibonacci to get your standard deviation. Where do you target? You can target this low or this inefficiency for your take profit. For your take profit, it's either you target a liquidity resting below or any inefficiency resting below. Price is coming to deliver inside it. You can anchor from the high to the low to get your standard deviation. You can target 1 minus 1.5. You can target 2. You see, to get your standard deviation, that's how you anchor it. Whenever you see a displacement like this, in a scenario like this, when we took out a liquidity, then we had a change of structure, that displacement, market shifting structure. Then you anchor your Fibonacci to get your standard deviation below price. You can target a liquidity resting below or here in this inefficiency, the half of it, that's consequent encroachment. You can get the half of it for your take profit. Then you can put your stop loss above here, above here. You see price didn't get there again, price didn't reach there again. So probably you will still be in profit. Then your take profit, you target standard deviation minus 2 or minus 1.5 for your partial. Okay, yeah. So that's our topic for tonight. Okay,
Okay,
yeah. We call it a day. Thanks for showing up.
no problem. Thank
Yeah,
you.
be safe.
Okay.